from London. Hi, Jonathan. Thanks so much for joining in. Today, top of everyone's mind, that Chinese flash PMI data that came out, disappointing than what the street estimated. We haven't seen any big reaction, or the markets are not down 1%, 2% odd. What was your understanding of that particular data point?
Yeah, obviously, the Chinese markets themselves, the H shares and stuff, did initially react quite negatively. The data China still seems to be the focus of global attention, and obviously the data was worse than expected. And yeah, it's the manufacturing sector is clearly still suffering quite considerable pain in China, and obviously the employment in that sector as well seems to be under quite some pressure.
Do you think concerns about a slowdown in China will continue to weaken the equity market? Do you expect this data that we've got from China to trigger a second leg of correction? Because the August one did, spark off the correction that we saw.
Well, I mean, from our view remains that China still has plenty of firepower that it can obviously put in place to try and stabilize the Chinese economy, and we certainly expect that. I think, obviously, what happened back in August was more of a surprise with, obviously, the currency move. We're not going through that at the moment. We've just got bad data. We've been used to bad data for some time, but obviously with the particularly skittish sort of attitude to China that we're going through currently, people are sort of latching onto that data. Our own view is, perhaps there's a little bit more weakness to come out, but we still, as I said previously, do expect the Chinese authorities to continue to ease. There are also pockets of some good signs. Some certainly in the property sector, we are seeing signs of price stabilization and even price increases in certain cities. So, selectively, it's not all bad news, but obviously the market, in the mood it's currently in, tends to focus on the bad pieces of data.
All right, Jonathan, the last time we spoke, you told us that you're sitting on higher levels of cash, and also you prefer to have more of India in comparison to China. Has anything changed? What is the cash you're sitting on currently? Still at elevated levels? Are you dipping in? And do you think that your exposure to India is going to be increasing?
I would think, yes, in an emerging market sense, India still retains its sort of unique position to some extent. Obviously, it is suffering from broad emerging market withdrawals, but actual Indian-only, funds are still, I think, looking quite attractive. So certainly from our perspective, we have been dribbling a little bit of cash in. Unfortunately, it feels like a little bit too early, but we're finding reasonably good valuations in certain counters. So we've still got, we haven't put all our cash to work. Our feel is probably markets will test to the downside before hopefully having a nice final quarter.
So when you say you expect the markets to test some more downside before having a final quarter, how much lower does it get from here? What would your analysis be or expectation?
We're not going to put a level on it, but we'd expect the market probably to retest the lows again that we saw back in August. And, hopefully, obviously India does have a number of catalysts that other emerging markets are lacking. We're certainly looking and hoping for some sort of response out of the RBI later on this month, some sort of cut there. So India does, have its relative attractions here, but obviously it is still getting wrapped up in the global risk-off type of environment we seem to be in.
Yes, we are hostage to global cues, but if the markets do touch the August lows of, say, 7,500 that we saw in the Nifty, you still expect a good quarter to wrap up this calendar year. What gives you that confidence that we will see a bounce back?
I think it's a number of factors, really. We've had a pretty vicious sell-off. We've also, generally speaking, we are, as I said previously, we are not quite so, dreadfully bearish on China as consensus seems to be at the moment. I think China is obviously facing problems, but we do think the data will gradually stabilize and begin to slowly turn around. So we're hoping the China factor sort of moves away for a little bit, and obviously emerging market shares in particular, and global stock markets have had a considerable sell-off. So, the factors are, I think, we're used to the news to a certain degree. that there is a lot of bad news in current stock prices. So I think just no further bad news for a little while could be a cue in itself. And then in addition to markets like India, where hopefully we'll see more interest rate cuts, then that sort of sets us up for a reasonable final quarter, I think.
Okay, Jonathan, on that optimistic note then, we'll know whether or not we're getting the rate cut in the next 1 week call. Thanks so much for joining in, giving us your take on China, what's going on in the globe, as well as your stance on India as well. The Nifty is as far as